S&P is up 8% this year, up more than 25% from the October lows, as you know. Our next guest says there is still gas left in the tank despite today's higher inflation print. Joining us today from the airport, Tom Lee, Fundstrat Global Advisors, head of research. Tom, we were looking at your photo on social media a moment ago. Thank you for joining us, even from the gate.
Yeah, glad to be here, Carl.
Tom, you literally wrote before the CPI print that there could be a non-intuitive outcome, and that is you get a hot CPI print, markets rally, and that's what you would consider to be a bad news priced-in scenario. Is that what we have?
Yeah, it looks like it. I think, the bond market was bracing for a hot CPI print. That's why the inflation break-evens had drifted towards 4, and I think equity markets were kind of nervous ever since Friday. So we got sort of that rip the Band-Aid moment where it was a hot CPI print and the markets are rallying. I view it as a good sign. But I also think when people look at the details of that CPI report, I'm left with the idea that there's this residual seasonality that makes the January and February CPI look worse than it is. And in the next couple of months, it really should start to normalize, and that's going to be maybe what the stock market's discounting.
You've been pretty candid in recent months, Tom, about warning clients about what you see as sort of tactical, treacherous territory. I think it was maybe last August you said, look out, tactically we might be in for some pain. Are you seeing any repeats of that?
I think it's still early days, Carl. It is a maturing rally because we're now in the 20th week, and this is longer than the last two rallies since October 2022. The longest before that was 19 weeks. But I think there's fundamental anchoring that's supporting why stocks should rise, and I think positioning is still really light, but we could see it in the margin debt being low and the record cash on the sidelines. So I think that's why we feel there's gas in the tank, and Mark Newton, our head of technical strategy, still sees pretty good breadth and a pretty healthy market. So I think today overall is a good sign. We had a bad CPI print in markets out there. I mean, that's always good.
So I take it then, Tom, you disagree with the notion that Jamie Dimon shared yesterday that there's a little bit of bubble in equity markets right now.
I think it's hard to distinguish what's a bubble versus what a market's repricing, because this year, 30% of the S&P earnings growth came from NVIDIA. That's not a bubble. It's really just this big step up in demand, and we've seen a lot of use cases for AI, and companies talk about how much it's added productivity, like Klarna, which is a buy now, pay later company. So to me, I think there is a fundamental story anchoring this that's causing future growth to go up, and it could feel like a bubble, but it's really a market sort of recognizing a mega trend.
Tom, at what point do cuts become critical to supporting these valuations versus the prospect of cuts?
I think it's going to be important. To me, if the Fed raises rates this year, I don't think the S&P would be going up because it means that the framework's been wrong. So I think a Fed not cutting is also not a great outcome. I think cuts have to happen this year. But I think there's some patience in equities because I think that investors are starting to understand the residual seasonality that's making January and February look like inflation's picking up, but it probably starts to tank in the second half.
Tom, appreciate that. Nice call, at least tactically today, if these gains hold. And safe flight. Talk soon.
Alright guys, this is the part of the video where I break down the stocks that were mentioned in the CNBC clip. Really, Mr. Tom Lee only mentioned the major markets, so we'll break down the SPY, the QQQ, the DIA, and the Russell 2000. We'll go ahead and get started breaking down the SPY. You can see basically it's just a massive cup and handle with a breakout that's hugging the 21-day moving average. We've got 1, 2, 3, 4, 5, about 5 bounces off of it. We're still breaking up to the upside today. Today is a bullish day. We're up 0.84%. Should be headed towards a full percent up, if not more. So we're definitely not headed back down. But once we either retest this 21-day moving average or break it, we're due for a consolidation sideways, maybe even a pullback back down to 470 or so. We'll have to find a support, be able to base there, turn around, and make a new all-time high. But as of right now, you make the trend your friend. You don't fight the trend. But guys, we are getting kind of top heavy, just so I can caution. We are still almost 2% above the 21-day, which is what we've been bouncing off of. So even a 2% drop is something. But more importantly, we're 11.5% from the 200-day moving average, guys. So we are starting to get a pretty good distance here. You can see the last time we had a big distance of 11-12%, we came straight back to the 200-day. So I wouldn't be too surprised if we have another pullback similar to this within the next couple weeks. Let's go ahead and look at that. QQQ should be pretty similar. We've got a major cup and handle. Look at it, holding that 21-day moving average. It's touched once, twice, 3, 4, 5, 6, 7. So it's touched 2 more times than the QQQ. You can see it's even kind of started to make a pretty solid bottom here. It's definitely looking bullish. It's rejected going lower, rejected breaking through the 21-day moving average. And so far, it's still looking bullish, guys. Once we do break this 21-day, same for the SPY, we will be due for a sideways consolidation to a pullback. We will need to find a new support base, make it a strong support, and be able to take off again to go any higher. Now the Dow is looking very bullish. They have broken their most recent high. Let me go ahead and mark it out for you. Let's see. We'll call it here. Even though support and resistances are mainly ranges, we'll just call it this line. You can see they had a high, got rejected, came all the way down during the Rona crash, and has since come all the way back up, made that resistance a support, and is going higher. They just started to break through the 21-day, but it's actually was just a fake out. Looks like it's holding it pretty strong. So the Dow is looking pretty strong, guys. Watch that 21-day moving average. We are just barely hugging it. And if we break through, we could go 4 to 5% back down to that most recent all-time high, or we could go back to the 200-day moving average, which is about 8% down. Lastly, we're going to break down the Russell. You can see pretty straightforward, major run, major correction, and a very strong triple bottom base right here. You can also see they had a very strong resistance, so they were in a channel for a good while between here and here, just bouncing back and forth. They finally broke out of the channel, and now we're starting to break above. This was a fake out, came back. This was a rejection. It's still wanting to break above it. So far this is bullish, guys. This is showing a lot of signs that the bulls are beating the bears, because the bears definitely want to take it down from this level to show another rejection. So as long as the bulls can keep it above, we'll call it $2,000. The Russell 2000, the small caps do look bullish, and hopefully they can continue back to all-time highs. I hope you guys enjoyed the video and learned something. If you do, smash that like button and subscribe. Share it so I can grow the channel, and I appreciate you watching. I'll catch you in the next one. Peace.